Do you ever wonder whether it's possible to survive a stock market crash? In this video, we're just going to cover a few things. So we'll cover what is a stock market crash, what causes a stock market crash, what happens after previous crashes, should you be buying the dip, and how do you manage to weather any crash that may come. Hi, welcome back to the channel, and if you're new here, hi, I'm Mark of Desperately Seeking Fi. It isn't a very pretty picture out there at the moment. If we think about it, the Nasdaq last year dropped by about 35%. UK inflation still surprises everybody when it still holds above 10%. And the Fed continues to increase interest rates, now sat at the highest they've been for the past 40 years. There were some green shoots back in February with the FTSE 100 managing to peak up to that 8,000 mark, but in March it took a bit of a dive and fell approximately 10%. Nobody really knows what's going to happen, but we have analysts predicting that US recession odds continue to rise and that they are now at 70%, and that has just gradually grown over each of these Bloomberg analyst surveys that they do. What does this mean? If America sneezes, the rest of the world tends to get a cold. So if it happens in America, we will expect that we will go into recession as well. What is a stock market crash? Stock market crash normally is something unexpected happens. So it may be a black swan event. So it could be something like COVID, the war in Ukraine, but shares tend to drop. And typically for a crash, we're talking about a 10% drop in a day or over a couple of days. It can be temporary and it can come back up again. It may take a couple of weeks. If it's a crash, it might be the start of a longer downturn in the market, and if we're getting into that territory of 20% drops, we're starting to get into the terminology of a bear market. This could take months and potentially even years, as it did back in the Great Depression of 1929. This chart shows us that stock market crashes aren't that unknown, and we can see right back to 1870 right up to COVID-19 there have been stock market crashes. What causes a stock market crash? This can be several different reasons. As I previously mentioned, it could be a black swan event, something that we haven't even predicted happens, like COVID-19, the war in Ukraine, or it could just be we've been in a bull market, so prices have been rallying up and people just feel that everything's become too inflated, too expensive, too overvalued. Potentially you get some of those bigger holders of stocks start selling. And if we start that selling process, what happens? Prices start going down. They start spiraling down. People start to panic going, and everybody then gets into that fear, uncertainty, doubt, the FUD, and they start selling. And if everybody starts selling, the price starts rocketing downwards. Macroeconomics can also play a huge part in this. So far, we've seen inflation rates topping out 11% in the UK, something similar in the States. They just seem to have brought theirs down through more aggressive hiking of interest rates. But what does that mean? The hiking of interest rates to bring inflation under control puts less money in your pocket. So what are the three takeaways? Valuation of particularly growth stocks. Like, look at how expensive Palantir and Peloton and Tesla were last year. Last year, they were quite low in comparison to where they had been during COVID-19. You see reduction in the valuation of growth stocks. You see consumer spending reducing. We have less money in our pocket with the price of food going through the roof. Energy costs and everything just costing more means you have less money, and people tend to want to try and put a little bit away if they can, just to ride the storm. What else happens? To ride out that storm, we've now got some bank accounts offering 7%, so people move their money out of the stock market and into those far less risky options, which will give them potentially nearly as good a return. Have a look at the Money Supermarket link down below, where you can have a look and see where some of those best saving rates are in the banks. Stock markets crashing is not anything new. We've seen this before. We have some pretty major things have happened. We had World War I, the Spanish flu influenza, the 1929 Great Depression, the post Second World War bear markets, Cold War, Cuban Missile Crisis, Vietnam, inflation, Watergate. We have Black Friday, the lost decade, COVID-19. We've had lots of crashes in the past. And look at that chart, it continues to move upwards. So if we have confidence that this is a cyclical thing and that bear markets and crashes come around and then we see a bit of growth, let's just try and stick with it. Let's focus in a little bit more on what has happened since 2000. The FTSE has performed like this over the past 20 odd years. What can we learn from it? Firstly, it is very cyclical. Major falls up to 50% are not unknown and sort of happen on a 8 to 10 year average. How long does it take to come out of them? It initially, back in 2000, was taking about 4.5 years. Same again for the global financial crisis. Brexit was a little bit quicker, and COVID-19 was a little bit longer. So how long does it last? Who knows? In reality, since 2000, FTSE has risen by about 15%. And if you had bought in towards the bottom of the dot-com bubble, financial crisis, or potentially even COVID-19, you would at least have doubled your investment. Take heart, there are potentially opportunities. And that leads me on very nicely to, should we try and buy the dip or sell the fall? Everybody gets tempted to try and hit the bottom of that or identify when a crash is coming. In reality, it's really difficult to buy the dip. You will tend to miss it. Even the professionals manage to miss it. So what hope do us mere mortal and retail investors have trying to time the market? Always think it is time in the market and not timing the market. What I'll be planning and doing is I'll just be holding on to what I have at the moment and looking at trying to buy in, because as the price goes down in a crash, you will be buying things at a cheaper price. When we see that return to growth, which obviously we all hope will happen, we see that we make a greater upside as it happens. And this quick chart from IG just shows you the fall price for different stock market events and what the return was like then the next year. So if you're actually buying in, and just set and forget, I always say we need to have a goal of where do we want to be in 10, 20, 30, 40 years. Don't try and beat the market, just try and smooth out your averages. And as you see things then go up, you will see increase in your investment portfolio. So how do we weather any potential stock market crashes? This just basically becomes a simple investment strategy. Look at diversifying into different sectors and countries. You can do this through picking different stocks and making sure that you have a spread across different sectors, or the way I would rather do it, and this is the way that I invest the majority of my money into the stock market, is invest into exchange traded funds. Look at ones that cover a multitude of sectors and also countries, and that way you provide yourself with diversification. Also important to look at having diversification into different asset types as well, be that into other non-equity based assets such as bonds, properties and commodities. So you could be looking at something like a life strategy from Vanguard, which gives you a holding of bonds in there depending on what your risk appetite is like. You've obviously got your own property if you own that, and you could look at buying into commodities, things like gold, silver, or some of the rare metals. Something that is really important when we're looking at investing into different assets is try and ensure that they aren't correlated. So what you don't want is everything correlated, so that when the stock market goes down, you end up seeing everything else coming down in price as well. That isn't what we're trying to do. We're trying to get, when one asset falls, the other one rises. You could achieve some of this by buying exchange traded funds. There are lots of them out there that look at commodities. So you will have ones that track the spot price of gold and silver. You will also have ones that will track property. Potentially you could look at some form of real estate investment trust ETFs. I've done a video, just have a quick look at why I quite like REITs. And you can look at ETFs that track fixed income assets such as bonds. Timing your investment really is quite difficult, particularly when you don't know what's going to happen with the market, and nobody has a crystal ball and knows exactly what's going to happen. So there are a couple of options. You can either do a lump sum buy in and just leave it. I don't like doing that. I've done that in the past and it hasn't quite worked for me. What has worked is sort of buying in with smaller amounts that I can afford every month and pound cost averaging into the market. This basically means that you buy as the price is falling, so you are able to buy more shares or units with your money, and as a result you end up paying a better average price across the whole period. And what does that mean? When things pick up again, you get a slightly better return. And as we always say, to try and protect yourself against stock market crashes, have a longer term investing horizon. So looking at that 10, 20, 30 years. If you've got longer, even better, because you get compound interest kicking in as well. Have a look at a video we've done on that and how you can become rich using the 8th wonder of the world. I hope you find some of those ideas useful to try and weather any storm that's coming up. As I said, have a look at investing in low cost index funds or ETFs. Why not have a look at this video that gives some ideas of some dividend ETFs that you can invest in. Thanks very much for watching. We'll see you in the next one.